Hi, this is the long-term historical chart of Bitcoin, all the way starting from the middle of 2010 to today, the middle of 2021, 11 years of price history. And so the question of our questions is, are we going to see another big bear market, another 90% drop or 80% drop or 85% drop as we have seen in the past? So is this drop that just started over here just the beginning of something that might look again like an 80% drop, which would bring us to a price of like $12,500? Or is this just a little hiccup, maybe similar to what happened in 2013, where we shot up, consolidated for a while, and just used that time to have another major run up? So that's the question of our questions. Nobody can answer this definitively. But what we're going to do in this video is we will look at different approaches to look at the price data, to look at on-chain data, to see what different indicators told us during those tops in the past and what those approaches tell us about this current top that happened here. So one thing to note is that it's easier to determine when Bitcoin is cheap than when Bitcoin is expensive. So I think timing the market and finding out when to buy is much easier than finding out when to sell. And that's because of several reasons. Say when prices are comparatively cheap, you usually have a long time frame to actually buy and accumulate. You have basically accumulation zones. So it didn't really matter when during those kind of times you would have bought. Quickly thereafter, prices were rising and you were able to make profits. So the price tends to be in a bear market state for a comparatively long time. Picking the bottom is relatively easy. That's very different from trying to time the top of a market. In order to sell at the top, you have a very short time frame. So you just have a few weeks, maybe even only days, where you can sell for a really high price. So buying low is easy. You're likely to buy low if, for example, you would have bought at any date in 2016. But when you're selling, you must have picked, say, the end of 2017 in order to sell really high. It's much more likely to either sell too early or too late. There's also quite a few approaches to pick the bottom relatively easily. So just drawing this kind of channel is one approach. But what you can also do is just look at the 4-year moving average in Bitcoin. And whenever the price went close to this moving average, you also have very cheap prices. Now finding something equivalent to time the tops is harder. One approach that we could take is we could look at how far is the price away from the moving average. So since the 4-year moving average takes quite a lot of data and we can't really look at how much the price extended from this moving average for the earlier cycles, what we can do is look at the price extension from the moving average for shorter durations. So let's take the 2-year moving average. So here we got this big extension over here, and here we got one, and here, and then we got the recent one. And let's look at how far did the price actually get above the moving average, and where do we currently stand with this extension over here. So what you see here at the bottom is how much higher was the price compared to the moving average. So at 1, you have the cross of the moving average. So that's this blue horizontal line over here. And then we've got a peak over here at around 14. So the price here at around 1000 was 14 times higher than the moving average. And what we can see for those market cycle peaks is that the extension from the moving average tends to decline. So this one was a 13x. This market cycle peak here was only a 9x. And so obviously this is not exact science. We can only see that in general it's somewhat declining, but it's hard to say where exactly the next peak should be. So are we going to see now another increase to say 4 times the moving average? Or could we even go up to 6 times the moving average? Are we going to get down to the moving average again? This is what used to happen, right? When we had these big extensions, most of the time it went down all the way to the moving average again. But what I find interesting about this is that this rally here in the middle of 2019, right? The rally that happened after this big crash, where we basically went up almost 300%, this peak over here was not very extended from the moving average. The moving average extension at that time was really, really low. And so at that time, it was rather obvious that this is not a cycle peak. Right now, this doesn't look as obvious to me. We are not that heavily extended compared to the last cycle that ended end of 2017, but we can expect that this cycle's extension won't be as high. So finding the bottom is easy, finding the tops is much harder. And so what I practically make out of this is there's this very common approach to dollar cost average into the market, to just keep buying when prices are low and then try to ride the wave and then exit. But since it's comparatively easy to time the low prices and comparatively hard to time the high prices, the opposite approach is probably better. So not to diversify too much in terms of timing when prices go down, because they might go down further, because actually determining when prices are low is easy. So when buying, it probably makes sense to have comparatively large sums to invest and do this rather infrequently. And so when there's a real crash or when we get really close to, say, the 4-year moving average, then it makes sense to go in very heavily and to invest really heavily. But when it goes up, since we can't really time the exits that well, maybe it makes sense to dollar cost average out with more trades and in smaller increments. So in other words, when there is a crash, when there's blood in the streets, maybe invest like amount X here, then maybe a few months later again, and then a few months later again. But then once it rises and once it extends from the moving average, since we don't know, will we go all the way up or will we go down again? Once we do extend, then instead of buying every few months, maybe it makes sense with smaller amounts to sell every few weeks, because we just can't time the tops that well. So you diversify your exit prices over time. You do this kind of diversification much more when selling than when buying. So DCAing out is more important than DCAing in. Now still want to know, how far have we come? Are we going to go up again or maybe low to this 4-year moving average? It's hard to answer this, but let's look at different models. So one of the most common approaches is just the logarithmic regression over the Bitcoin prices with a channel above and below for buffering. And when we just look at this and we zoom in over here, we can see that this first bull run out of the depression in 2019 just hit the middle of this logarithmic regression, but that now with the recent bull run, we haven't been able to hit the top. We went above what happened in summer 2019, but we haven't hit the top yet. Now, if you just look at a risk versus reward from this perspective, it does look like it's attractive to consider buying, but since we just said that purchases should probably happen rather on the lower end, because when prices are depressed, they tend to stay depressed for longer, it probably makes sense to rather wait out until we hit the bottoms here, which is maybe at around 18, 19K, somewhere in that region. Now, just by looking at this regression, we can see that these big market cycle tops that brought us down these 80% moves, they all hit the top of that regression line. And we can also see that the regression line in general is flattening over time and tightening over time, which does make sense because over time, the Bitcoin price has to grow less and less in relative terms because the asset just becomes bigger. And so it can't double as quickly. And it also makes sense that this channel here gets narrower because over time, the price stabilizes and volatility decreases. And so the gain you can make in a bull market or the loss you have to endure in a bear market, those magnitudes, they decline over time. Now by this graph, it looks like the recent peak we had was not the final peak because all those other peaks, they hit the top line. So just by looking at this, a market cycle top could be expected maybe at around 120K, 115K, something in that region. But we are a far cry away from this. This is another 4x from here. So this channel tells us we might have more room to grow. Another chart that implies that we haven't seen the top just yet is the realized HODL chart. So what you can see here is that in these big market peaks and those macro cycle peaks, this realized HODL indicator always went all the way up to this red area. And again, we are very far away from this. Now, what does this chart here show? It's an on-chain metric that measures how much are the long-term holders of Bitcoin currently selling or buying. So it looks at different wallets. When have the coins been moved? And when wallets that haven't had any transaction for a long time suddenly start becoming active, that's when this indicator here is pretty high. And so the long-term holders, they start selling. And what we can see is that recently during this high, not a lot of people were selling. And so this would imply again that there's more room to grow higher. Does it have to go higher? Of course, nobody knows. But that's why we look at different models to come up with an overall picture and to get an idea when we should start selling into the market and when we should start buying into the market. And it's always good to diversify those timings, to not put all eggs into one specific point in time, to buy everything at one point in time and to sell everything at one time. But because these models only give a certain indication and none of them are perfect, it makes sense to just use them to gauge general sentiment, but to still basically hedge your bets and find multiple entry and exit points. Now, before we go into the next chart, if you enjoy this content, please give this video a like so the channel can grow. Thank you. Now, another reason why many people don't see this as the market cycle top is because of trading volumes. When you look at this top over here, you can see that the trading volume was very high. The same goes for this price top over here. So a lot of coins have changed hands during this very active trading period. Now, if you compare this to the recent top, the trading volume was not particularly high. In fact, it was higher afterwards when prices went down. And the same goes for the price movements. During those hype phases, normally the price shoots up and then comes down quickly. It shoots up, comes down quickly. Same goes for here and also for what happened in 2017 and 18. Now, clearly this top looks very different. Here we shot up and came down. Here we stayed at this elevated level for quite a long time. So in 2017, we had this maximum excitement, a lot of trading volume with a very quick decrease in price after the bubble burst. So the price was at these elevated times for just a very brief period. Recently, however, we went up and we didn't have elevated volume and the price stayed high for a longer period. And so we didn't have that much of a mania phase. We didn't have this blow off top where people just get uber excited and push up the price that quickly that selling pressure builds up just equally as fast. And so just by the sheer price pattern and by the fact that people aren't trading actively, you could see this whole interruption of this run up here just as basically that we ran out of fuel. So there was just not enough money to come to push this price higher. But it wasn't as before where we just went up too quickly and people got scared of the elevated prices. This time it's just there wasn't enough activity to push it higher. It's a different kind of top. And it's maybe similar to the top that happened here in 2019, where we also had relatively low volume and where we stayed at a high level for a prolonged period of time. Another interesting indicator to look at is the Puell Multiple. I'm not sure how to pronounce this, but what it does is it looks at the daily issuance, which halves every 4 years, and it divides it by the moving average, by the 1 year moving average of the price. So this basically looks at how much money can miners make, or how much do they make compared to a 1 year moving average. And so what you can see is when they do make a lot of money, that there is potentially more sell pressure, which would then potentially depress the price. And when they don't make a lot of money, miners might hold onto their coins and thus the price tends to rise. Now again, what we can see here is that the market cycle peaks have been predicted relatively well. This has probably been retrofitted. I'm not sure when this indicator was made, but at least in the past it worked relatively well. What we can see though, that the peaks themselves, they also tend to decline. So the very first peak was the highest and the 2017 peak was the lowest. And so again, when we look at this, we might think, okay, is this just declining and this was our recent peak? Or are we going back into the red area? Nobody really knows, but what this indicator here tells us right now is that we are pretty much in balance. Risk versus reward is pretty balanced. So it's neither an exceptional time to buy nor to sell. And this is also pretty much in line with what we saw with the regression chart. This is another on-chain chart that looks at the activity on the blockchain of Bitcoin. What you see in yellow over here is the percentage of points in the last year that have not been moved. Or in other words, the lower this yellow line, the more active coins move from A to B. And so when you look at these bubbles here, these red bubbles, this is just in addition to indicate where are the macro cycle tops and then what is the corresponding value here on this activity metric. And what we can see is that the tendency is whenever there's a market cycle peak, that the on-chain activity is comparatively high. And whenever there's a market cycle bottom, that activity is relatively low. So think of this yellow line as in how inactive is the blockchain. And that kind of makes sense, right? When prices are depressed, there's not a lot of attention on Bitcoin. And so there's not a lot of transactions. And thus you would expect high prices when there's a lot of activity and low prices when there is not a lot of activity. And so this metric isn't perfect for market timing. We do see a bit of a lag here. Activity still continued to rise up until March after the peak. And we also see that even after the bottom, activity continued to fall. But what's interesting here is that activity tends to increase since around September last year, when the real bull run started off from the 10K to our current price. That's when the on-chain activity in Bitcoin really increased. And it doesn't look like there's a reversal just yet. That doesn't mean we haven't seen the top yet. We had something similar here in December 2017 where it continued to decrease. But now it's interesting to see what happens going down the road. Are we going to see increased activity? So is this line going to continue to fall? If yes, it's likely that prices are going to rise again for Bitcoin. But if now we suddenly see a reversal and we see less interest in Bitcoin and this yellow line actually increases again, then this would be bearish for Bitcoin. Now, another interesting way to look at attention on Bitcoin is to just use Google Trends. So this is a chart of how often has the term Bitcoin been searched worldwide in the last 5 years. And what we can see here is the big interest spike of Bitcoin at the end of 2017, then a big decline in interest, much less people were searching for Bitcoin, then a little bit of an intermediate peak in the middle of 2019, which coincides with this price peak over here. And then just recently, say since November 2020, interest started to pick up again and is still relatively elevated. Now, there's two ways to interpret this, right? We are not as high as we used to be. So this is kind of in line with the other metrics we looked at. There's no real hype phase, nothing comparable to what we've seen before. The train just kind of went out of steam and not enough more money was flowing into the system to push prices higher. But the way you can also see this is there is potential room to fall, right? Because only when interest is at its lowest, when nobody is looking for Bitcoin, only then do we potentially have really bargain prices. So you don't want to be the last person buying when everybody talks about it. You want to be rather against the general public and be the person that's interested in crypto when nobody else talks about it. And right now we are pretty much in the middle, right? It could go either way. There's definitely room for going down from here. We are still at relatively elevated levels. So let's see where this goes. Just go to trends.google.com, search for Bitcoin, and you can have a look at this chart yourself from time to time. There's one more chart I want to show you. Again, an on-chain metric, the reserve risk. And that indicator as well has always peaked in the red area whenever we had a market cycle peak. And right now we are far away from this. We almost get into the green area. And I don't want to go into the details of how this is calculated, but basically it's a very similar approach to the realized HODL line. It looks at how are the long-term holders of Bitcoin behaving? Are they selling? Are those old wallets becoming active? Or are they waiting to sell and hope for higher prices? And so we can see not a lot of people took advantage of this recent top. And so if the long-term holders are right, we might see another peak again and get back into this red area. If you enjoyed this video, please give this a like. YouTube will then grow the channel. If you haven't yet, feel free to subscribe. And we've also got a Telegram channel in the video description down below. Feel free to join there as well. See you next time. Bye-bye.